And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say.
Hey guys, welcome to Everyday Finance. When the market is dominated by fear and consumer spending becomes more constrained, this is typically the time when genuine innovation begins to emerge. Economic unpredictability not only leads to the elimination of weak businesses, but it also paves the way for the emergence of courageous new leaders. During the financial crisis that occurred in 2008, many businesses failed. But future giants were quietly gaining ground well before the market officially recovered. This is something that history demonstrates. In a similar vein, Cathie Wood sees the current climate not as a collapse, but rather as a launch pad for the nation's future. She remembers how her strategies started to perform better in late 2008, which was several months before the market began to recover. What is the reason? In every case, genuine leadership and innovative disruption emerge before the recovery, rather than after it has occurred. In light of the fact that customers are looking for more value and investors are looking for guidance, a new generation of companies that are defining their industry is already gathering momentum. The next wave of winners is beginning to take shape beneath the noise, whether it be fintech, artificial intelligence, or other next-generation solutions. There is only one question that needs to be answered. Who are they, and how soon will they emerge? This is the time to keep a close eye on things, because those who are able to identify these up-and-coming leaders at an early stage could potentially reap enormous rewards. Watch ahead.
Onto monetary policy. Here, I've presented this a number of times. It does seem like CPI, which is in the green there, is kind of stuck in that 2 to 3% range. Now, there are other measures of inflation out there that are saying something different. There's a measure called Trueflation, and we'll have it for you in the next, I think we're going to subscribe to their service, so we'll have it for you in the next package or in the next In the Know. It is saying that inflation is down to 1.3%. And this is a real-time measure of, I don't know, I used to say millions of products and services, but I think it's more like tens of thousands or thousands, but real-time, constant monitoring. And it peaked at 11% just about the time that the CPI peaked around 9%. It is now down to 1.35%. And as you may also notice, the oil price seems to be under severe pressure because Saudi Arabia is opening the floodgates. Purportedly, it is railing against Kazakhstan and Iraq overproducing and is just opening the spigot. There could be other reasons. Part of the negotiating out there, President Trump, I think, is with Saudi ministers this weekend, maybe even MBS himself. And there may be, and as he's been very vocal about getting oil prices down. So that may be part of what's going on here as well. Of course, the third variable is weakness in the economy. So all of those accumulating, which is going to take that trueflation measure of inflation down even further. So we've often said we would not be surprised to see deflation, And you can see we have seen it at times in the past, certainly in COVID and in 2015, 16, when there was a lot of fear, a lot of volatility in the market, and a lot of fear about China imploding. So this is the picture of velocity, the velocity of M2 on a year-over-year basis. It peaked at 11% and is now down to roughly 1.5%. This is a fourth quarter number. If we're right, and there's there's seizing up in terms of spending, just holding off until the coast is clear, whether it's tariffs if you're a business, or a person's job. Is that person going to keep his or her job? Until the coast is clear, there's going to be a bit of a pullback in terms of the rate at which money turns over, the rate of spending, velocity. And with money growth on a year-over-year basis of only 3.9% as of February, that's a February number, if velocity turns down on a year-over-year basis, which we do believe it will, there will not be much room for nominal GDP growth. If money's around 4% and velocity starts to fall on a year-over-year basis, it is falling sequentially. It fell in the fourth quarter sequentially. Then that means that nominal GDP growth, mathematically, this is just math, will be below 4%, dropping from its recent 5% level. So now I'd like to show you some charts. I mentioned high-end consumer. It had been faring pretty well and had been spending. But you can see on this next chart that after holding in, consumer sentiment of high-income earners, so that's the purple line here, capitulated in March. And you can see that low and middle income have been, the sentiment levels there have been very low. And take a look at where we saw this kind of mood historically. It wasn't even this bad during COVID. You have to go back to 08, 09. So the mood out there is pretty grim. And I think this crack in high-end consumer sentiment is one of the reasons we'll see a negative GDP quarter in the second quarter as well.
The debt-to-GDP ratio in America has risen to levels not seen since World War II, and this time there won't be an economic boom to save us. Budget surpluses were brought about in the 1990s by political cooperation and growth. We are clinging to flimsy solutions like meme-driven cryptocurrency and hoping that tax cuts will perform a miracle in today's polarized system. The signs are conflicting and concerning. Taxpayers are overburdened, oil prices are falling, and inflation is unclear. Even though commodities have fallen to levels seen in the early 2000s, gold remains the most popular safe haven. The $250 billion in stablecoins has helped keep Treasury yields below 4%, which is an odd contemporary pillar of support in a shaky system. Bitcoin is holding its ground over the long run, but it is having difficulty outperforming gold. Global markets are also changing as a result of Saudi Arabia's aggressive oil production. It's possible that the 4-decade-long trend of declining yields has finally reversed. Cathie Wood views this as a significant turning point as well as a crisis. We've moved into an area without a historical roadmap. She said that deflation driven by technology could totally challenge conventional wisdom in the field of economics. Old tactics might not work in this situation. What happens next will depend on whether innovation can keep up with growing debt or if history is set to repeat itself in a different way. Let's watch more of her interview to gain a deeper understanding of her thoughts. Watch more to Wood.
I've seen these charts for years and years and years, but I didn't realize that we had hit from a public debt as a percent of GDP, that we had hit the peak we reached in World War II. In the 2000 timeframe, there was the thought, could we be heading, in the tech and telecom bust, could we be heading towards that level? But here we are. And, that was a crisis time, and the country really did pull together after that to get the debt as a percent of GDP down. It did it in two ways. More control over government spending. Of course, we weren't in the war anymore, so that was a big source. But also on the GDP side, rapid growth. Post-World War II, very rapid growth. Doge, we think, is an attempt to pull us out of a quagmire, it seems, in terms of government spending. It's what held the economy up, or real GDP up, along with high-end consumers during the last few years. But this is certainly excessive as we see it now in context. And you can even see in the 20s, in the 20s and 30s, we didn't get anywhere near this level. Another look at the budget, and you can see total outlays as a percent of GDP, around 24%. Now, what is not clear from this chart, but I do know, having studied this, is that receipts tend to top out in the 17 to 20% range. If the government tries to tax people any higher, they figure out ways around it. They either stop working or they do a lot more under the table. I don't know what it is exactly, but that receipts as a percent of GDP rarely goes above 20%. So this deficit is structural. And I do believe that with Doge and with more rapid GDP growth, we could move back into the period like the 90s. That was the last time we saw a surplus, and it was under President Bill Clinton and Newt Gingrich, who was a powerhouse in Congress, and they worked together to get that done. We do not have as much of a bipartisan situation right now, so we'll probably have to do more on the rapid GDP growth side of things. And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say.
We've observed that economic upheaval frequently serves as a catalyst for change. While consumers were gripped by fear and frugal living during the 2008 financial crisis, daring innovation subtly started to transform entire industries. Adversity isn't a dead end. Rather, it's a fertile ground for disruption, as visionaries like Cathie Wood have recognized. Real leadership emerges before the market recovers, as evidenced by the fact that her investment strategies started to outperform long before the markets did. We are currently experiencing a comparable storm, and once more, innovation is brewing beneath the surface. Just as previous tech disruptors redefined their industries, cryptocurrencies and stablecoins are forcing us to reconsider money itself. According to leaders like Cardano founder Charles Hoskinson, geopolitical tensions and the global trend toward decentralized finance could drive Bitcoin's price to $250,000. More is involved. Once regulations are in place, the adoption of stablecoins by tech behemoths like Apple and Amazon has the potential to fundamentally alter the financial landscape. Emerging technologies could be the new stabilizers in a world where political divisions prevent traditional solutions, and the US debt is skyrocketing. The seeds of tomorrow's leaders are being sown now, as is the case with every downturn. Innovation has the potential to reshape value, wealth, and the way economies operate, particularly in the fields of cryptocurrency and decentralized technology. We are left with the question, could Bitcoin emerge as the new gold, the preferred hedge in a world where fiat money is becoming less and less popular? We are moving toward that future. Thanks for watching.